So next we'll be starting with a new topic known as capital structure. So here what are we trying to do is, we are trying to find out the optimal capital structure. Capital here means what, sir? Finance. Meaning from the source through which you are raising the finance. Whether you're going for equity shares or retained earnings or preference shares or debt. We are trying to find out which is the optimal source of finance. Like, let's say for a project, no, we need 10 crore rupees. To do one project, we need 10 crore rupees. Do you think I'll be able to raise entire 10 crore just from one source, or I may require multiple sources? May require multiple source, or I may want to raise it from multiple source to diversify. Quite possible. Okay. Let's say I want to raise this 10 crore through debt and through equity. I want both. I don't want only debt, nor do I want only equity, because both of them have some advantages. Also, they have some disadvantages. So I want to take both into my portfolio. Okay. Now the question is, in what percentage I should raise through debt and what percentage should come through equity? Whether it is 30%, 70%, 80%, 20%, or 50-50, or what? This mode of finance, or this percentage, or this mixture, I'm trying to find out through this particular topic. Okay, I'm trying to find out the optimal. This is your capital structure. Yes. So I'm trying to find out in this chapter, what's the optimal capital structure which will maximize the value of the firm. Which will maximize the value of my company. If I make 20% equity or 80% equity like this, what proportion may I should raise the finance so that my value of the company is maximized? That is that mixture I'm trying to find out through this particular problem, or this particular chapter deals with those sort of problems. So got the meaning? So tell me once, what is that? Capital structure means what are we essentially doing over here? Finding out that optimal capital structure which maximizes what? The value of the firm or the value of the company. Here value of the company, or firm, we denoted by the symbol V. Capital V. Capital here, V stands here for value of the firm. Okay, sir. And we already know source of finance we raise keeping three factors in mind: R, C, C. Risk, cost, and control. All those we have done any which way in the first topic itself. Yes, no? Same thing again, they have brought it in here. Are we good, sir? All right. Just like a few past topic, here also there will be some formulas. So can I write a few formulas and understand them a little better? The first I'll list them down one way in one page so that it'll be easy for you. One, I said V. What is V, sir? V here stands for value of the firm. Value of the firm is given by the formula EBIT divided by K. V, you know what does V stands for? Value. EBIT means earnings before interest and tax, or instead of EBIT you can also call it as PBIT, as in profit before interest and tax. That's fine. KO, I think you already know, that is your overall cost of capital. If you do this, you're going to get the value of the firm. That is one. I'll maybe list down one by one first. Then we'll spend some time on that. Value of the firm is also given by S plus D. S is nothing but market value of equity. D is nothing but market value of debt. Then what else can I write? Or maybe let's spend some time on this only, then we'll go for the next formula. Okay, sir, check this. Sir, suppose I'm planning to raise a 10 lakh rupees by issuing 10% debt. I'm planning to issue 10% debt and I'm planning to raise how much? 10 lakh rupees. Assume that the tax rate is 0. Assume tax rate is 0. So there is no NP data or redemption data and etc. etc. So that means what is the cost of debt directly, sir? 10%. Yes. Okay. First of all, okay, can you tell me the interest amount? Interest amount. How do you calculate the interest amount? Express this in formula for me instead of calculation. You will take the value value of finance, correct? No. Can I write value of finance, or I can write value of debentures, or I can simply write value multiply by what, sir? Interest rate. Agreed? Yes. Okay. Value of finance raised here is 10 lakh. Interest rate is raised how much, sir? 10%. That means your interest amount will come up to 1 lakh. Any problem in this? Anybody? Okay. Can I say this is the return for the debenture holder? For the debenture holder, will he pay the interest or receive the interest? Receive. So that means it's a return for him. Correct, sir? Okay. So this is a return for him. Yes. Okay. Excuse me. So that means his return percentage is 10, can I say? For him, the return percentage is 10. For him, it is a return means for company, it is a cost. For company, it is a cost. If you have raised only money from one source of finance, this cost only becomes your overall cost of capital. So overall cost of capital will change. We need to calculate if there are multiple source of finance. In my example, I have multiple source of finance or only one? Only one. So if your cost of debt is 10%, means your overall cost of capital also will be 10% only. Yes or no, sir? Everybody good? Now, 1 minute. If I give you this data and if I give you this data, can you find out this for me? If I give you these two components and ask you to find out the value, can you find out? Express that in formula for me. Let's see. Just formula may you express. Value is given by? Value is given by? This is X, assume. If it is not given. If it is X means what you will do? How will you find it? 1 lakh divided by 10%. Correct now? What is that 1 lakh? Or can I say return amount? Because that interest amount is nothing but the return for the debenture holder. So interest amount you can write, or return amount divided by the interest rate, or can I say return percentage? Are we okay, sir? So far, any problem? Okay. Now, let's refine this formula. Value of the firm is denoted by V. Sir, for a debenture holder, it is a return. But if company has to, what you didn't get? I didn't explain on it. You said didn't get. What I did? I don't know. When you type that message? When do you type that? What you didn't get? The? Which portion? Some interest amount you did not get. The. What is the interest amount here? The? How do you calculate interest amount? Debenture value multiplied by interest rate is interest amount. No, that's how you calculate. No? Yeah, this is a calculation. Is there a problem in this calculation only? There's one I boxed. You should type pause. You should not keep quiet and leave it there because I'll be waiting. Is there any problem in this boxed number? Got it. Okay. Maybe you logged off. Huh? Okay. So if I have to find out this now, if this component is missing, how do you find out this? Value of finance, if you have to find out, means it will be what? Interest amount divided by interest rate. Correct? No. If I give you these two and if I ask you to find out that, then you will apply this formula. Interest amount divided by interest rate. That interest amount only I'm calling it as return amount. Instead of calling it as interest amount, I'm calling it as return amount. That's all. And instead of interest rate, I'm calling it as return percentage. Just the naming change I have done. That's all. Okay now? Fine. Okay. All right. Sir, if for debenture holder, if he has to get the return, means company has to earn that amount. See, how much interest the company has to give here? 1 lakh. Without earning any money, can company pay off the debenture holders? Huh? They have to earn. Yes or no? Correct? So you can substitute your formula here. Instead of return amount, it will be EBIT. What is EBIT? Earnings before interest and tax. Before paying the interest, company should at least earn 1 lakh rupees. Only then company will be able to pay the debenture holders 1 lakh interest. Agreed? If the company earns 1 lakh, they will be in a position to pay the debenture holders 1 lakh interest. Correct? Only after deducting interest, you will pay tax. Hence, this 1 lakh is what? It is EBIT. Okay, na saru? Instead of return amount, it will be what, sir? EBIT. For a debenture holder, it is a return percentage. For a company, it is a cost. That cost here we are calling it as K. Because you will not have one source of finance, you will have generally multiple sources of finance. Hence, the formula is constructed like that. EBIT divided by K. Is it okay? You just don't have to derive this. You just need to remember it. This is very important formula. First formula, are you able to remember it? EBIT divided by cost of capital. If you do, you're going to basically get the total value of the firm. Value of the firm here is nothing but value of the finance taken. Value of the firm here is nothing but what, sir? Value of the finance taken. Not book value of the finance taken. Market value of the finance taken. That's all. Here when we say value, it is nothing but market value of the finance taken. Yes, everybody. That's the reason I've written this formula. You can also find out value of the firm adding two things. What are those? S plus D. Generally, you'll raise the finance either by giving equity shares or by giving debt. So if you take market value of equity and if you add market value of debt, you'll get the total market value of the finance taken. That only we call it as what? Value of the firm. Either you'll use this formula or you'll use that formula depending on the question ka data. Manageable. These are the two formulas and reasonably, have you got it what I have said? Yes. Okay. Tell me once again. Let's see. Value of the firm here denotes what, sir? Total value of the finance taken. Okay. And so that is denoted by the formula or denoted by the symbol V. So V is equal to what? EBIT divided by overall cost of capital K. EBIT divided by KO. That's one way to get it. Or you can also get it as, generally we see only two types of finance being raised, debt or equity. So take market value of equity, to that you add market value of debt. You will get value of the firm. So why not preference shares? Debt is always better than preference shares. In some other topic I'll tell you. So generally companies don't issue preference shares because debt plan is better. Or simple term mein, debt mein interest rate is fixed or varies. The rate of interest that you pay on debenture is fixed. The rate of dividend that you pay on preference shares is also fixed. Preference shares carries what rate of dividend? A variable or fixed? Fixed. But on interest or on debt, you get a tax benefit. But on preference shares, will you get tax benefit? Now you tell me, compared to preference shares, which plan is better? Debt plan. That is the reason debt plan always dominates or is better than preference shares. So hence many companies prefer to issue debt than preference shares. Hence in this formula mein, you don't see preference shares. Okay, and in this problems mein also they don't give preference shares. Comfortable? Okay. Can I move on to the next?
You told preference share dividend will be fixed.
Also,
if they are attaining loss.
Generally, you have read in your Companies Act, unless otherwise told, preference shares are always cumulative, non-participating, non-convertible. This is the Companies Act 2013. You must have learnt it in your CA foundation. So preference shares are cumulative, meaning even if you don't pay this year dividend due to loss, next year you have to pay next year dividend along with previous year dividend, because dividend goes on accumulating. That is it. You have to pay it. Any problem so far? Only two things we have learned. Are we good with this? Okay, so I'll just see what else I can take you through. So this is done. These two are done. Okay. Maybe I'll also explain this. Another formula you need to remember is, I'll write a fancy one. Let's see who gets it. Cost of capital is given by cost of debt plus debt divided by S plus cost of equity multiplied by S divided by D plus S. Another way to calculate cost of capital. Did anybody understand that? First of all, what is KO? Overall cost of capital. What is KD? Not me. What is KD? Cost of debt. What is a D, sir? Market value of debt. What is S, sir? Market value of equity. Is it okay? Okay. It's nothing but actually this you know. You have done this. It is just there's nothing but your weighted average cost of capital ka table. That they have expressed in alphabets. Like if I have to tell me what are the tables, sir? First is source, weighted average cost of capital. How you used to calculate? Source of finance. Then you used to calculate amount. Then weights. Then you used to consider cost of capital. Lastly, it was weighted average cost of capital. Okay, let's suppose it was equity and debt. Let's say equity is 70, debt is 30. So what will be the total? 100. I'm taking a smaller number just to put up that. Okay. 1 minute, sir. Equity here we call it as what? S. Debt we call it as what? D. Okay. Now calculate the weight for me, everybody. How do you calculate the weight? 70 divided by 100. Yes, no? This is in numbers. This is in numbers, correct now? Can you express this for me in alphabets? The 70 by 100, can you express for me in alphabets? What is the 70, sir? It is equity. Equity is nothing but we're calling it as S. How did you get 100? By adding S and D. So denominator is nothing but your S plus D. Yes, this is your cost. Here you'll write cost of equity now. How do you get overall cost of capital? You take cost of equity and multiply by S divided by S plus D. One aspect. Yes or no? That is what I've written in the first aspect here. Or here rather. Cost of equity into S divided by D plus S or S plus D. Whatever. Okay. Similarly here, debt. Again, wait, if you have to express in debt, how it will be? It will be 30 divided by 100. 30 is what, sir? 30 is your debt as in D. 100 is what? S plus D. And then you take cost of debt. How do you get overall cost of capital? Cost of debt into D divided by S plus D. That is what I've done here. Yes or no? Fancy formula, but that's what we've been doing it. Yes or no? Another way of expressing the same thing. That's all. Okay. Any confusion in the three formulas that we have actually written over here, or all good? Offline, all cool? Online, what are your thoughts? Fair enough? Clear. Okay, these three are supposed to remember for the time being. I'll tell you more if required. Hang on. Good, they're saying. Okay, for now, let this be there. I think we can move forward. I'll come back to those three again. Now, capital structure theories are there. Few people, they have done their own analysis and they've given their own thought process. That we are calling it as capital structure theories. To broadly classified, theory can be broadly classified into two things. Relevance theory, irrelevance theory. I have not written, huh? Okay, no problem. It's okay. So, theory can be broadly classified into relevance and irrelevance theory. It is there in the chart book. Here I should have gotten, they have given it individually, but it is not given over here. Okay. Under relevance theory, relevance theory, I'll call it as R. Irrelevance theory, I'll call it as IR. There are two relevance theory: net income approach, traditional approach. These two are relevance theory. Under irrelevance theory, you have two more: net operating approach, MM approach, Modigliani and Miller approach. Okay, we'll just spend a little time on this. There's a little bit of theory, not much expected in examination, but quickly we'll run it by, just in case they ask. At least two points we'll remember to be on the safer side. Okay, so we have what theory I said, sir? Only broadly two theories. What are those? Relevance and irrelevance. Under relevance theory, well, let's take up the first one. First one is what? Net income approach. Carefully, just don't need to write down anything. Just listen to me. Everything what you need to remember, I've brought it in the chart books. It is there. So you don't have to make summary notes. I've already done that for you. You just, for now, just listen. That's good enough. So what does net income approach says? First of all, net income approach is what sort of a theory? Relevance or irrelevance theory? It's a relevance or relevant theory. What do we mean by relevant and irrelevant is, under relevant theory, they are arguing, few people have argued that debt is relevant to increase the market value of the firm. Under relevance theory, what are they arguing? Debt is important to increase or decrease the market value of the firm, or rather debt impacts the value of the firm, as in V. Under irrelevance theory, they are arguing that debt does not have any impact on value. That is what they are arguing about. Two sides. Ruling party, opposition party. Okay, ruling party is saying yes, opposition party is saying no. Like that. That's all it is. That's all is our relevance and irrelevance theory. Got it? So first let's take up the first relevance theory, which is what, sir? Net income approach. Net income approach is saying this. Hey dude, debt is cheaper. We already learned this. Which is a cheaper source of finance? Debt or equity? Which is a cheaper, not costly. Which is cheaper source of finance? Debt. Because the people who invest in debt are taking more risk or less risk. Okay, or else if you invest in equity, you are taking more risk. If you take more risk, you will expect more return. So the cost of the equity will be high. Debt people are taking little less risk as compared to equity share holders. So the debt is always cheaper when compared to equity. Yes, our first statement is okay. We have discussed this in the first topic. Just reiterate again, telling it for your reference. So debt is cheaper when compared to equity. So what this theory argues is, since debt is a cheaper source of finance, use debt bindas. If you want to do any finance or if you need any money for investment, no, first catch hold of debt. Take as much debt as possible because the debt is cheaper. So what it is trying to say is, debt is a cheaper source of finance, one. Okay. Another one, what it says is, since the cost of the debt is cheaper, what it is trying to say is, since the cost of debt is cheaper, overall cost of capital will be lesser. If your cost of debt is lesser, your overall cost of capital will be lesser. Because of this, your value of the firm will increase. I'll prove everything, don't worry. With numbers, we'll prove. This is a theory or summary that they're trying to say. Debt is cheaper. So compared to equity, cost of debt will be lesser. Since KD will be on the lower side, your overall cost of capital also will be on the lower side. Hence, the value of the firm will be increases if you use more and more debt, is what this particular theory is arguing. Can we maybe prove this two portion first? Okay, these two numbers we will prove. Okay, let's maybe calculate. Let's check here. Source of finance. Amount I'll directly write weight, and then what do we write, sir? In WSEC, cost of capital, and then we write KO. Correct? I'll take debt and equity. Let's say debt ka weight was 0.5, equity ka weight also was 0.5. So that means the total weight will be 1. I'm just assuming random numbers and proving it. Okay. Let's say cost of the debt was 10%, cost of equity was 15%. So calculate KO for me. This will be 0.5 into 10. How much? 5. This is 0.5 into 15, which is 7.5. So this is how much? 12.5. Are you okay? With this data, you're getting overall cost of capital to be how much, sir? 12.5. Let's modify the data slightly. Source of finance, same. Weights, cost of capital, KO. Debt, equity. Let's make the debt to be 0.8. How much was the weightage of debt before? 50% or only 0.5. Now I've increased the debt because that's what this theory is arguing. No, if you increase the debt or if you use more and more debt, your overall cost of capital should reduce. Let us say, and equity now, if debt ka weight is 0.8, means equity ka weight will be 0.2. Equity ka cost of capital is 15, debt ka is, let's say, 10. Okay, how much will be this? 8, and this will be how much? C. Okay, how much is this? Actually, this should be ulta. How much is that? 15.5. Did I take wrong numbers there? Okay. Actually, 0.3. My bad. Okay, how much is this? 3. So numbers are right. Okay, how much is this now? Overall cost of capital, how much are you getting? 11.5. Easy, everybody? Yes? Correct, no? How much was the overall cost of capital before? 12.5. Now, how much is the overall cost of capital? 11.5. So, KO increased or KO reduced? Manageable. So, what have I written in the first junction there? If you use more and more debt, your overall cost of capital will reduce. Have I proved that to you? Just by assuming random numbers, that's all. You can take any other numbers and prove it out for you. First observation. Clear, sir? Okay. Now, online also good, no? If you use more and more debt, your overall cost of capital will reduce. That's what we have proved using this particular example. 11, okay, not 11.5, they're saying it's 11. Okay, done. But either way, it is reduced. That is the point I'm trying to make. Okay, no? Alright. Let's also prove this. I'm also saying if overall cost of capital reduces, then value of the firm will increase. Let's also test this out. Sir, you already wrote one formula. What is that? V is equal to? Someone said? Huh? Actually, yeah. Yeah, this I've actually did. I was trying to say cost of debt is cheaper. When I wrote that downward symbol, I meant cost of debt is cheaper. Yeah, and actually, I can just take out this and say right here as use more and more. If you use more and more debt, then overall cost of capital will reduce and the value of the firm will increase. That's what I'm trying to communicate. Forget about the upward and downward arrow. This is what I'm trying to communicate. Okay, now. All right. So now let's prove this. How do you get value of the firm, sir? First formula, EBIT divided by KO, correct? EBIT divided by overall cost of capital. Let's assume some random numbers. Let's say EBIT is 1 lakh. Overall cost of capital, let's say, is 10%. Assumed. 10% means I will write it as 0.1. Can you tell me what is the value of the firm? 10 lakh. Any problem? Okay. Let's modify this data. Let's say EBIT is still 1 lakh. What is the equation we are trying to prove? Is if cost of capital reduces, here I've written here, if cost of capital reduces, then the value of the firm will increase. So initially I took cost of capital how much? 10%. Yes, no? That is your 0.1. Now I have to increase or reduce? Reduce. Let's say I'll make it as 8%. Just a reduction. That means the denominator will be 0.08. How much is the value of the firm? Calculate 1 lakh divided by 0.08. How much? 12 lakh 50,000. 1 lakh. 12 lakh, no? 12 lakh 50,000 is the value of the firm that you're getting. Yes or no? So what happened to the value? Is it same or it increased? Your cost of capital, overall cost of capital got reduced, but your value increased. Is it okay? So that's what they're trying to say. Meaning between overall cost of capital and value, there is an inverse relationship or ulta relationship. If cost of capital increases, value of the firm will reduce. If overall cost of capital reduces, then value of the firm will increase. That is what this theory is trying to argue. That's all you need to write. 3 pointers. Manageable? Any confusion? No. Let's recap that once again. First approach, your net income approach. What is it saying? Debt is a cheaper source of finance. That is the reason you have to use as much debt as possible. Because if you use more and more debt, your overall cost of capital will reduce. So hence value of the firm will increase. That's 3 points. Can you remember? This is your first relevance theory. Meaning debt does have an impact on the value. Can I go for the next theory? 2 theories we'll do and then we'll do a few problems straight away. Okay, next is traditional approach. Next, this is also a relevance theory only. Traditional approach. What traditional traditional approach is trying to argue is, yes, we acknowledge that debt is a cheaper source of finance. So if you use a debt, initially what will happen is, when you start using more and more debt, initially overall cost of capital will reduce and hence the value of the firm will increase. Okay. But after a certain point of time, because you're going on borrowing and borrowing and borrowing, no? Okay. If you go on doing that, lender also will give you the interest at the same rate or he will increase. Let's say you are able to borrow 10 crore loan at 10%. If you go on borrowing, will you get 10% only or he may increase it? He may increase it. So if you go on doing this activity or in future, gradually what will happen is your cost of debt will increase. Because interest rate definitely will increase because risk is increasing. Correct? What will happen to your cost of equity? No, that will also increase because you're taking too much borrowing. Okay. Shareholders ka heart will saying baga 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 baga. Why? Company is going on borrowing. Suppose if they don't have money to repay, they have taken too much bank loan. If 1 year, suppose COVID happened or few things, tragedy happened, what do you think will happen to the company? If they don't have money, what bank people will keep quiet? Shareholders, papa will shut and keep quiet. But will bank people do that or they will come to the company, sell all their assets and recover? Recovery agents will come. Hence, if you take more and more loan, what happens to the risk element? The business becomes more and more risky. So equity shareholders are taking too much risk means, will they expect same return or higher return? Now the business has become more risky means the expectation of equity shareholders will increase. So cost of equity also will increase. That means what happens to your overall cost of capital? If both of these are increasing means overall cost of capital also will increase. And hence value of the firm will again fall back. This is what traditional approach is trying to argue. Everything is right. Actually, there is no magic formula. It has to be assessed from business to business, but they have given theory, and unfortunately for the sake of exam and marks, we need to study and write. Practically, what is relevant, what is irrelevant depends on the company, and it also depends on the scenario. Yes, if the debt is available, if the market condition if your debt is available at a very cheap price, it makes sense to take more debt. If debt is very costly, then it makes sense probably to issue equity shares. Again, it all depends on the risk appetite also of the company and scenario. So straight away you can't generalize, practically I'm saying, but here examination you need to remember. Yes sir. So what does the traditional approach ka simple funda? What does it acknowledge? That yes, debt is cheaper. So up to a certain level, if you go on borrowing the debt, since debt is cheaper, your overall cost of capital will reduce. Hence the value of the firm will increase. But there will come a certain point of time where you will not be able to borrow at the same rate. The borrowing rate will increase. So cost of the debt will increase after a certain point of time. Because you're taking more and more debt, the businesses become more risky. Hence expectation of the equity shareholders, as in cost of equity also will increase. Because of this, your overall cost of capital will shoot up and the value will reduce. That is what traditional approach is saying. Basically, they are saying use debt, but cautiously, not left, right, center. Use debt judiciously. That's all. That's what is the argument put forth by the traditional approach. Manageable, 3 points. That's all. Use debt judiciously because of these two reasons. Brought it. Same thing. I've written it in words in the chart book as well. Any doubts if you have, or okay now? Yes, Saru? I think before you nod off, let's take up a few questions. Or hang on, maybe I think there's one more. I think I'd like to prove that. Sir, how did you get the value of the firm, sir? EBIT divided by K. And you wrote value of the firm as what? S plus D. That is nothing but market value of equity plus market value of debt. This V here stands for value of equity or value of the firm? This V here stands for value of the firm. 1 minute. Can you also find out value of equity? Market value of equity is denoted by what symbol? S. Can you find out market value of equity? Check. No, not this. Forget, using this one. This one I know. You know what? That's fine. I'm not talking from this approach. I'm talking from this approach. Okay. Just check. I'll write here. Let's say EBIT is 1 lakh. From EBIT, what do you do, sir? Deduct interest. Let's say this is 10,000. What are you going to get? Earnings before tax, which is 90. From this, you will deduct tax. Let's say tax is 30%. So that means this will be 27,000. So earnings after tax will be how much? 63,000. In this problem, generally preference shares will not be there. Even if it is there, simply maybe I'll write. Let's say preference dividend is 10,000 rupees. Assumption. So after deducting preference dividend, how much remains? 53,000. This 53,000 is available to whom now? Are debenture holders already paid off? Yes. Are preference shareholders ka dividend already paid off? Yes. So last money remaining belongs to whom, sir? Equity shareholders. So this only is what, sir? Ish. Ish means earnings available to equity shareholders. Or you can also call it as net income. NI. Our books uses the term NI, but we can, for our purpose, we can treat it as Ish. Are we okay? Using this only, you will find out the EPS and other things, blah, 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 blah. Correct, huh? Now, why did you take EBIT in the first formula? Because you are finding the value of the firm. Value of the firm means value of the total finance, no? Total finance means it belongs, will the debt people also be included? Yes. That is the reason you took earnings before interest and tax. Now, are you finding out value of the firm or value of equity alone? Value of equity alone. If you have to take value of equity alone, can I take EBIT? Is EBIT available for equity shareholders or what is available? Check in this problem. Which is available to equity shareholders? Each or net income. So numerator instead of EBIT, it will become each. Okay, now denominator, is it KO? No. So we are trying value of equity. So that means here you'll write instead of KO, it will be cost of. So substitute to find out the market value of equity. Comfortable, Asaru? Market value of debt will be given to you in the problem. Okay, so market value of debt, they've not derived anything. So this is the way, another way to find out the market value of equity. So these are the things that are necessary for around 4 to 5 problems that we are about to solve. That's all. I think this should be good enough. Need some time or can we get started with the problem? Okay, they're saying good. So let me proceed then. Come to question number 1, sir. Anyone copying anything? Okay, first question. Whatever I've written as a simple form here, no, everything is there in your notebook, both in the chart book as well as your main book. Okay, just for simply summary purpose, I've written this. Each. Okay, simple, sir. Here you're finding value of the firm. Here you're finding only market value of equity. So whatever only equity related data you substitute. Is EBIT available to equity shareholders? No. What is available? Each. So instead of EBIT, substitute with each. That is your numerator. Denominator, you will not take KO because your KO means it's for the whole firm. Are you finding whole firm ka value or only equity ka value? Only equity. So substitute KO with the one related to equity shareholders, which is cost of equity. So that's your plain substitution. That's all. Gokulji, ಅರ್ಥమైందా? ಅರ್ಥ ಪ್ರಾಬ್ಲಮ್ பார்க்கலாமா? Okay. First question. Rupa's EBIT, this one company, they have an EBIT of 5 lakh. Company has a 10% 20 lakh debentures. So the interest rate that you have to pay on debentures is 10%. The equity capitalization rate, that is cost of equity, is 16% given. Okay. You are required to calculate market value of equity as well as market value of firm. Market value of equity means they're asking you S. Market value of firm means they're asking you B. Also, they're asking you overall cost of capital, which is K. Simple. Use the data and figure out these two. Can we fatafat do it? Question number 1. Okay, let's maybe figure out, do some number crunching here and then maybe we'll go further. So to find out the value of the firm, what is value of the firm? I don't write this down. We're just doing, we're seeing what we should start with. Okay, how do you get value of the firm, sir? EBIT divided by overall cost of capital. That is one way. Have they given you EBIT in the problem? Yes. Have they given overall cost of capital in the problem or are they given only cost of equity? They have given cost of equity. Mind you, you have debentures also here, meaning debt also is there, equity is also there. So is this 16% also overall cost of capital or no? This is only cost of equity. This is not overall cost of capital. Overall cost of capital, have they given? It's missing. So can we apply this formula straight away and get the answer? No. Okay. That I think we are stuck. We have one more problem. What is S, sir? Market value of equity. How do you get that? E should divided by cost of equity. Cost of equity have they given in the problem? Yes, it is 16%. Each have they given in the problem? No, but can you find out? Yes. How do you find out each, sir? Just now I put it up here now where it went. Each is nothing but from EBIT, if you deduct all these components, you're going to get any which way what? Each. Yes or no? Interest rate have they given? Interest rate have they given? Yes, 20%. Debenture ka value have they given? Yes, 20 lakh. So can't you find out interest? Yes. So basically we need EBIT. From EBIT, if you deduct interest, what are you going to get? Earnings before tax. From this you have to deduct tax. You're going to get earnings after tax. From this, if you deduct the preference dividend element, you're going to get the each. Do you know interest or are you able to calculate it? Yes. I mean, I will be able to calculate EBT. Yes. Tax rate have they given in the problem? Sir, my favorite rate is 20%. I will assume. Bad. If they have given the tax rate, take it. Otherwise, take the tax rate to be 0. So that means tax element is 0. Can you find out earnings after tax? Yes. Preference dividend not given. So that means that is also 0. Can't you find out each now then? So you each they have not given, but you can find out cost of equity any which way they have given. So can't you find out S here?
Yes.
So that means we'll start with that. That's whatever. I think we can find out this information. Can we do that? Okay. So first I'm trying to find out the market value of what, sir? Equity, which is denoted by the symbol S. So first I'll calculate EBIT given. Yes, how much is the EBIT given? 5 lakh. From this you will deduct the interest. What is the value of debentures given in the problem? 20 lakh. And the interest rate on debentures is 10%. Both here given. So the interest element will be how much? 2 lakh. So earnings before tax is 3 lakh. From this you have to deduct tax. Tax rate not given. So I'm taking it as 0. So earnings after tax also will be 3 lakh. From this we have to deduct what? Preference dividend. Preference dividend data given or no? No data. Hence we'll take it as 0. So finally what are you going to get? Each or also known as net income, which is how much? 3 lakh. In this problem, you don't have to write all this if it's an exam. Directly, this 3 lakh only, you write it as, instead of EBT, you directly write it as each. Because anyway, tax is also not there. Preference dividend is also not there. Just for your reference, I'm writing this in your notebooks. If you want in this problem, you copy it down in your notebook like this. In examination, instead of EBT, directly write each. That's okay. Ideally, actually they're using the symbols over here in FM. Yeah, I think it's okay. EBIT according, yeah, they're using EBIT form. It's fine. Use it. Sometimes it is dicey, very difficult to tell whether short form is acceptable or not. We have to check whether study material is using it. If they're using it, we are safe. Otherwise, bad. Like that, you know. Anyway. Yes, sir. So this is done. So I'll call this as 1. Next, what do we need to find out the market value of equities? One more component we need, that is cost of equity. Have they given cost of equity? Yes, cost of equity is given to be 16%. 16%, can I write it as 0.16? Yes. So how do you get market value of equity now? Market value of equity. Anyway, here only I've written market value of equity and denoted it by the symbol S. So directly you can write S over here. That's fine. How much is that? Or can I say 3 is equal to 1 divided by 2? Basically, E is divided by cost of equity. Correct, sir? That's what I'm expressing it as, 1 divided by 2. Each is not acceptable in exam. Don't write each. That is actually, normally I'm using each because we use that in AS 20 also. Accounting standard 20 called earnings per share, which we will see it in advanced accounting. There I use that. So just to give you relevance, here also I'm using the same thing. Okay. In examination, write full form. Earnings available to equity shareholders, or use net income. Don't use this short form. EBT, EBIT and all is okay. This short form do not use. Write fully, or just write net income. It's okay. So yeah, how much is this now? 3 lakh divided by 0.16 gives you how much? 18 lakh 75,000. Should I have to show the calculation or got it everybody? 3 lakh divided by 0.16 basically. That's what I've denoted as 1 and 2. If you don't want to write 1 and 2, you can write it as ABC. Any symbol, that symbol presentation is okay. So first requirement done now. Anything else they asked? Yeah, they also asked market value of the firm. So this is the first requirement they're asking. Market value of the firm. That is denoted by which symbol, sir? Market value of the firm. V know. V is equal to what, sir? D plus S, as in, or maybe here I'll write the full market value of debt, which is denoted by the symbol D, plus market value of equity, which is denoted by the symbol S. So V is equal to D plus S. check the problem. Have they given the value of debentures? Yes. How much is the value of debentures? 20 lakh. Have they given any other information? In these sort of problem, they will not give any other information. That means value of debt itself is 20 lakh. Value of the debt itself, generally it will be given to you. The given value itself is market value of the debentures because no other data given. So market value of the debenture is 20 lakh. Did you find out the market value of equity just now? Yes. How much is the market value of the equity you found out? 18 lakh 75,000. So what is your overall, or what is the value of the firm? 38 lakh 75,000. MV also bad. No short form. Write it fully. Market value. Market value. Class fine. Exam mein write full. Market value. Don't use short form. Cool, everybody? Okay. Anything else in the question they have given? Yeah, they're also asking you overall cost of capital. Overall cost of capital is nothing but your K. Okay, so well, let's find out that. C is your overall cost of capital. Which is denoted by the symbol KO. Multiple ways to do it. Do you know market value of equity? Yes. Do you know market value of debt? Yes. So that means, can you find out the weight of debt and weight of equity? Yes. Cost of equity, any which way they have given? How much? 16%. Cost of debt, is there any tax rate? Is there any tax rate in the problem? No. If tax rate is not there, means whatever is the interest rate, that only will be your cost of debt. So you know weight of debt, you know weight of equity. You know cost of debt, you know cost of equity. Can't you put up WSEC ka format and do it? Yes, that is one approach, but that is lengthy. I wouldn't suggest that. But hope you got what I said. Yes, no? Or simply use the one that you have learned right now. V is equal to what, sir? V is equal to EBIT divided by KO. V is equal to EBIT divided by KO. Do you know V as in value of the firm? Yes, value of the firm, just now you have got it. 38 lakh 75,000. EBIT you have to find out, or they only given in the problem? EBIT is given to you in the question. Check what is the EBIT? 5 lakh. Overall cost of capital KO given or missing? Missing. That's what we need to find out. Therefore, KO will be equal to what? This you have to 5 lakh divided by 38 lakh 75,000. Correct now when you send cross multiplication. This will be what? 0.12129 or 12.9% is your cost of capital. Like that. Or you can do WSEC method also, but that will be lengthier, which I kind of wouldn't suggest that in examination for this problem. But you can do that also. Hope both the approaches, what I said, made sense to you. Any questions or anything you want to copy? Online also good, huh? Anything you want me to zoom in on? Things are looking brighter. Yeah, as the time passes, I think things will look brighter and brighter because we have a Sunday and fun day coming up. All right, sir. Thank you.